Hey guys, this is Billy. I just wanted to share a few thoughts today. We've been experiencing some volatility in the markets, and I always like to take a minute and provide some context for people out there in the world who oftentimes don't know what to think of this or have trouble navigating or start hearing things and spooking themselves because they think somehow now suddenly they're in a Las Vegas casino and they've got their chips all on the table and somehow magically they're just going to disappear and the uh, the table is going to take all their money away. So let me just take a minute to explain what's going on in the world and the economy and the markets. Let's use some terms that you're all familiar with, but I want to give you an explanation and maybe give you some definitions that you can remember that'll help you navigate. The market has been on a pretty good climb, very little downside movement for the last several years, and it's just because of easy money, easy Federal Reserve policy. Businesses didn't have a lot of headwind. Now we have a different environment where we have a president who is trying to implement changes that are going to be good long term, but are going to create some near term unsettling. There's going to be some headwinds. So the tariffs are one. Some of the conversations they're having with other countries in charging other countries to sell their goods and services to us. Now, in reverse, many of you don't know this, but we pay other countries a big tariff to sell our stuff to them. So what we're doing now is kind of making the playing field more level, more balanced, and trying to support businesses here locally. So number one, don't believe everything you hear in the news media because they just rattle your cages and they get everybody kind of going in different directions, which is what creates this volatility in the first place. Because people, human nature, they start to look around and they start seeing people running for an exit and they start following. They don't even know what's going on. They want to get away because everyone's stampeding. Now, I've seen this in my career, which is nearly 30 years. Few times when the stampede gets absolutely insane, when people want out and they have no question, they don't even ask questions. They're just jumping. They were jumping out the window almost. And so I always tell people this isn't what you need to do. You don't need to follow the herd. Herd following is typically the wrong move when you're an investor, because smart investors do the opposite. They go the opposite way. Herd mentality is very, very dangerous. You don't want to get involved in that. But really, what does investing mean? What are we doing? You can invest in a lot of things, and some people call investments things that I don't. All right. And when we're talking about investing, we're talking about hopefully putting your money into something, buying an asset that's going to grow in value or pay you something back in order to give you a return on your money. And the return or the performance or the rate of investment appreciation is how we gauge that, how we measure, was that a good investment or bad? Many people have different feelings is what's good and what's bad. Some people think 2% return is fantastic, but I would tell them to analyze the cost of living adjustments because cost of living is still going higher than 3%. So if we're talking about 3 to 3.5% inflation rate and you're making 2, well, you're actually losing money. As my kids were growing up and when I talk to investors, all walks of life, I always tell them the basics of the US capitalist markets and how to become wealthy. Most of the wealth you'll see in the country comes from business owners. So tell my kids, if you want to be super wealthy, find a way to own a business, be a business owner. And if you don't have a way to be a business owner, you don't have the, whatever it is, you don't have the mindset for it, you don't have the desire to do that, or kind of what it takes is tenacity to go out there and start a business and see it through, you can still be a business owner, what's called a passive business owner. And that is through the US capital market. And you can invest in any publicly traded company and become a business owner in that company. It's easy. We can all do it on a daily basis. This is what I help people do all the time. So 47% of the millionaires in our country are business owners. 7% of Americans, however, only 7% of Americans are business owners. Yet 47% of the millionaires are business owners. So you can see where I'm going here. Now, 58% of Americans American adults own stock, whether that be through direct ownership of companies or through mutual funds or exchange traded funds. Most people own them through the mutual funds, and they own them through their retirement plans, like a 401k or an IRA. So there's that, but only 58%, which is maybe to you and maybe to most people that hear this, is a low number. I'd like to see more people own shares in the American dream and grow with the business appreciation over time. But when the economy gets rocky, then people start losing their minds. All right, everyone's fine when the markets are going up and the values of shares are going up, but then when things start coming down, they think, wait, I don't think I like this anymore, and they start to equate this being like a casino, like they're gambling, and they've got their chips, and suddenly they're going to lose them all. Let me remind you that when you're a business owner, like you are in these publicly traded companies, or when you own equity funds or shares of stock in a portfolio, you actually are a shareholder in that business. So the only way for them to take your chips away from you is if the company goes completely bankrupt. And remember, most people don't just own one company. They own dozens or even hundreds, sometimes thousands if you own mutual funds. So imagine a world where all these thousands of businesses that are publicly traded went out of business, went bankrupt, absolutely ceased to exist. Now, imagine that world and then decide if your investments are really going to matter anymore. Because in that world, I think the only thing we're all worrying about is staying alive. That kind of a world I think will never materialize. Now, I can't ever say never, ever, ever, but I would think you'd have to have something seriously, drastically wrong. Remember, in times like this, it's best to kind of tune out what all these talking heads are telling you. They make people feel like you have to do something. Most times, the worst thing you can do is think you have to do something. The best thing you can do in markets where volatile is turn it into an advantage for you. Imagine going to an auction where you want to own these certain assets that are being sold, and they're all on sale. Some people, they're just basically dropping them 50% off from where they were just shortly before. But if you're unwilling to buy when they're on sale, then you're essentially saying you don't think the value's there. You don't think they're ever going to come back. 5% of the time, typically, stocks appreciate in a calendar year. That means 25% of the time, you're going to have to get comfortable with the fact that they might go down in value, and they will go down in value. So you can't get fixated on what your portfolio value said on the high water mark. Because remember, it's not just going to keep jumping and jumping and jumping for the rest of your life. It's going to be periods when it resets and comes down. You might have a 5%, a 10%, a 20%. And then the severe recessions like we had in the dot-com bubble in the 2008 and 2009 real estate collapse, which was the worst of my investing lifetime, which we saw about a 45 to 50% decline in most equity. So the average equity value, so the S&P 500 stocks, we saw about a 48% decline. What you did in that period was the key. Some people said they lost it all in the market. Well, that's a fallacy. Don't believe that. That is not true, because if they lost it all in the market, one of two things, a couple things could have happened. One, they were invested in foolish things that went out of business, so then they did lose it all. Or two, they got to the bottom, the low point, and then they capitulated by selling when things just got to the peak for opportunity. When the values were at their very best, they jumped out the boat. And then they said they lost everything. Well, they didn't lost everything. They lost that 50% decline if they were invested in S&P 500 type securities, or maybe worse if they were invested in more volatile stuff like all tech stocks. They might have seen a 75 or 80% decline. That's why we never tell people to stay in just a handful of companies or one industry in particular. Diversified is more important. Remember, values come back. The S&P comes back. The NASDAQ comes back. It hits those old highs. Prices go up over time, just like prices of goods go up over time. It would be nice if we could go back 20 years ago and be able to buy a candy bar for 50 cents, or maybe 30 years ago, You all remember, those of you who are old enough, my age or older, prices back in your youth or when you were growing up for things like a Coke or a candy bar or a gallon of milk, you're never going to see those prices again in your lifetime. They're not going to go back to those levels. Just like prices of businesses, valuations of your homes, temporarily they may decline. You may see a recession where values decline and people aren't buying. The only reason values decline is when people aren't buying as much. They're selling more than they're buying. This is the supply. This is law of demand. Supply and demand is at work. This is how it works in capitalist economies. Short-term nature, you could see valuations come down. So just remember, staying the course is your best friend. Buying is an even better friend. So investing while market prices are giving you an entry point or a better entry point makes a huge difference in your long-term returns. So if you can flip that script and take advantage of this, if you're sitting on a large amount of cash with money markets, yeah, there's reasons to be afraid, but investing while you're afraid has always proved to be a better strategy than selling when you're afraid. So you give into your emotions, you've done the wrong thing. I know it's tough, but you have to remember there's positives to be thinking about, okay? Tax rates could be coming down. The inflation rates hopefully will be coming down. Now, I know there's some issues to work through. Not blind to the fact that there's some issues to work through in the economy. Don't always look at the pessimistic side. That's what the media tries to get you to do. Look at what the opportunities are. Think about where you could position yourself. And if you're a long-term investor, which is what you should be, or you shouldn't be an investor, period, you should be looking 10 years out minimum, then you should be taking advantage of opportunities when they come up. Can't wait till a bell rings, it won't ring. Just a couple of quick examples to maybe help me drive my point home. Think about good businesses. Remember, you're not gambling, you're not rolling dice when you're buying good businesses. So for example, if you owned Walmart, think about it. It's been around since 1971. That's when it went public, 1971 or 72. The average annual return for Walmart shareholders has been 18.68% per year. But you never got it clicked like exactly that number. That's the average. There have been many years when that Walmart stock was down. It was negative for the year. So did you just sell? I mean, it had a 20% decline in a given year and you said, I'm out of there. Think about if you owned the business, you started the company yourself and built it up your very own self, and you had a bad economy and your business slowed down for a year. Does that mean you're going to dump the business? No, you're not, because you understand the nature of the business and you believe in it. Same thing with Home Depot. It's been public since 1981. Average annual return for shareholders has been astounding 27.7%. Ups and downs, but averaging out to amazing returns over time by buying and holding. Third, Microsoft. So 3 different industries. Microsoft, technology company, been public since 1986. I'm picking companies that have been around for a while. 25.38% average annual return. These are phenomenal. These are way higher than the average for the S&P 500, which I told you is closer to 10 and a half. So if you invested $1,000 in Microsoft when it went public, that $1,000 today is worth almost $7 million. This is not hard to do. This is what I'm talking about, being a business owner. But in this way, you don't have to do any active work. You're a passive investor. You are participating in the company. So get comfortable sometimes watching values fluctuate. If it's driving you crazy, call your financial advisor, speak with them about how to navigate this, what you're doing to get through it, and make sure that you're talking to somebody before you just get an idea in your head because you listen to some dude on CNBC or on CNN tell you that the markets are going to hell and you need to get out. Okay, don't scare yourself into making rash decisions. I've done this long enough to see the good decisions and the people that have been successful investing and the people that ruin their financial plan because they cannot get away from the fear. So please use experts, use professionals. Advantages are here for the picking if you can take advantage of opportunities when they're presented. We don't know how long downturns last, sometimes way longer than we're wanting them to. But this is part of investing. And I really like these kind of times because it allows us to position into companies that we want to buy anyway, that just got a lot cheaper. If you can use that kind of mindset, I believe you're going to be successful. The last thing is, just because you're retiring doesn't mean you go all out of stocks and want to go into safety. That's also a big mistake I see people. It's a wrong mentality because investing requires you to stay invested for a long period of time through ups and downs, but outperforming inflation. We have to think about all the things that are going to be drags on our dollar, on our values of our dollars as we age. Sometimes a retirement can last 40 years. That's a long period of time. And to just throw it all into bonds or in a money market, you're going to suffer the consequences that way because you can't outperform inflation. Take advantage of markets. Don't be afraid of investing when times are ripe, when valuations get better. I'm not saying put it all to work right now. I'm saying start averaging in when values become appealing. Thank you for your time today. I hope this helped you. But remember, what we're doing here is we're not setting up a gambling, we're not a casino. You're buying shares in businesses, and that's how you need to look at it. Valuations can change, just like your house, just like any other thing you own. Over time, prices go up. Thanks for your time. Talk to you soon.